now we're going to talk about the bullish dual candlestick lines. And getting back to the idea of the signals being grouped together logically. So what I've come up with is what I call candle progression. So what we're going to do is we're going to have this black real body, the market's in the downtrend, and we're going to have the white real body move into the black real body. Okay, so we're going to have this, and then that, and then that, and then that, and then that. And these are all individual patterns. And what we're going to do is analyze each of these patterns in sequence. So the sequence, the way I made it logical is we have a black real body and how deeply the white real body gets into the black real body. Make sense? Right? And ultimately, actually, the white real body separates from the black real body. And essentially, if you just want to down and dirty, the more the white candle gets into the black real body, the more positive the signal. But it's not as easy as that. And I'm going to go through these. So these are all the candle patterns we're going to be looking at in order. This is the sequence. We have a logical order now. So we're going to first start with where the white candle gaps down on the opening and then closes unchanged from the prior close. It's a bullish counterattack. The basic criteria is the market is in a downtrend, but trend is not. Some of the candle signals, let me flip back here. Okay. Now notice that there's a red down pointing arrow here. Okay, that means this particular pattern has to be in a downtrend. This particular pattern has to be in a downtrend, okay? Or I should say, it should be in a downtrend. This one should be. It's not that important for this one or that one. For the bullish counterattack, the downtrend is, it's a two-session pattern, but I would like to see it in the downtrend, but it's not 100% vital that it's going to be in a downtrend. I'm going to explain why in a couple of minutes. It's a black real body. Think about this. Followed by a long white real body that gaps lower in the opening and then closes at or near the black candle close. So essentially what's happening is the market gaps down on the opening, and then by the end of the session, the market, and I'm going to read this is great, when the market gaps down, the bears are relieved. The bulls are backed into a corner and came out fighting in a heroic fight. Kamikaze fights are always frightening. So the bears, seeing this, may take to the sidelines, and the bulls may get reinforcements. So my question is, why do kamikaze pilots wear helmets? But I'm going to that, right? But think about this. The market gapped down on the opening, and the bulls come back fighting aggressively. Do you think there's a shift in psychology? Do you think the bears are getting a little bit nervous and the bulls are getting a little bit more optimistic? Now, this doesn't go into the white candle, but it's at or near the close. And I'm going to go over some important but subtle but important nuances here. First of all, I don't use this as support or resistance. Okay? I would consider selling for momentum trading, selling on a move under the low of the pattern. The strict criteria, and this is very rare, is that both candles are long. And the reason, when I say strict criteria, remember, it means that the pattern is better as far as giving us a change in trend because the pattern is implying a real shift in psychology. And think about it, if they were both long candles. So, the first black candle was long. Who's in charge? Bear. Now, to have a long white candle, what has to happen on the opening? Has to gap down really far, right? And by the end of the day, it has to come roaring back. So if you have a really long black and white real body, that's a classic example of it. It's pretty rare, but I just wanted to give you the classic example. So as soon as you hear the word gap, you're not going to see this in the Forex. Okay, while the ideal pattern is long black and long white, To me, the most important aspect is that it's a long white candle. Even if the first candle was not really a long black real body, because let's say if it was a small black real body, and if the market gapped down, like say $3, and came back to rally $3, that to me is really impressive. So to me, the bounce back on the second candle is actually the more important criterion. We'll look at examples of that. Closes don't have to be exactly the same. Don't worry about it. You know, if it's close to it. We'll look at the bearish counterattack. For all the bullish signals we're looking at, we're going to look at bearish signals. We're going to have the bear, just like we had that white candle getting into a black candle. A little later, we're going to have a black candle getting into a white candle. So this is the opposite of the bearish counterattack. So here's an example. This to me is a bull counterattack. Now this first candle is not a long black real body, but nonetheless the market gapped down sharply on the opening. So we closed on that black candle, a little hard to see probably for you. Closed at 29. The market opened at $26, folks. So it came back $3, about $3 by the end of the session. Do you need a more obvious sign of a change in psychology in the market? You know, it's not, you know, I wouldn't say it's as bullish as like a bullish engulfing pattern, but boy, if I was short, I would really have second thoughts in this. And I know we had a question about volume. What if we had a really large volume or high volume bounce back on the white candle? Isn't that sending out volumes of information? Okay. And I said here, what do you think the bears are thinking after the session? Watch your language, right? oh crap. Okay, now as the white candle gets into the black real body, we wind up with a piercing pattern. Now, for those who are really into the nuances of candles and have my first book, I talk about an in-neck and a thrusting and an on-neck. You don't have to worry about those. Essentially, those are candle lines where the close is at the prior low or less than halfway into the white candle. Don't worry about any of those. You know, as I mentioned before, I'm really focusing on the most important candle patterns. Those are not bottom reversal signals. The piercing pattern is a bottom reversal signal. So the basic criteria, and I'll go through this real quick because most of you should be familiar with the piercing pattern. 2 sessions, the market has to be in a downtrend. The market opens under the prior close at a minimum. I'm going to tell you a strict criteria on this. The market at least has to, on the white candle. Now, how do we know it's a white candle? What do we have to wait for? The close, right. So the market gaps down on the opening. It has to, at a minimum, be under the prior close. And then the candle has to be pushed more than halfway into the black real body. Okay, strict criteria. The white candle, instead of opening under the prior close, opens under the prior low. And think about why that would get a bear more nervous with a piercing pattern, right? Because not only is the market gapping down under the prior open, but it's gapping down under the prior low and then comes back. Okay, so strict criteria would be the white candle opens under the prior low, and also strict long black and long white, because we're seeing a real shift in psychology. Long black, bears are in charge. Long white, the bulls are coming back in a strong counterattack. The piercing pattern is used as support. The lowest low of the piercing pattern becomes a potential support area. And as far as support is concerned, and momentum, remember, kind of the same scenario. The low of the piercing pattern is support. If you're buying the piercing pattern, you use a stop under the low of the piercing pattern as a close. And for those who are momentum traders, if the market closes under the low of the piercing pattern, you could think about selling on that. Okay, here's Forex. Yes?
And to go long, would you wait for a confirmation, or would that piercing pattern be enough for you of a signal to go long?
Okay, the question is, if I understand, to go long, would we wait for confirmation? And the answer to that is yes and no. Spoken like a true politician. I should be running for president. The thing is that with the piercing pattern, if you wait for confirmation, you're increasing the probability of trade working out. But let's say we have a piercing pattern here, and there's a resistance area right over there. Okay, if you waited, first of all, this wouldn't be a good trade, but let's say maybe the resistance area is a little higher, maybe up here. All right, and let's say this was a good risk reward, although it's not, but let's say we're thinking of here. If you wait for bullish confirmation, like say over here, okay, this is just a circle, it's not opening, it's not over opening. You're going to have less profit potential, but I think you have increased probability of the trade working out. Once again, the plus of price confirmation is you're going to have higher probability because you're waiting for the next session to confirm the candlestick signal, which is great. You could do it on an intraday basis. In other words, if the market moves intraday above the close here, you could say, okay, that confirmed the piercing pattern to me, and you could be buying it, but realize you're buying at a little higher price. So, but you have more likelihood of it working. And I would suggest for longer-term traders, in other words, in trades for more than a week or two, you should look at price confirmation because you're probably going to be willing to take a little bit more risk for a higher-term profit. And we'll look at some charts if you want, with price confirmation. Okay, so for Forex, and this is where we start looking at differences between Forex and non-Forex. And by the way, for Forex, pretty much everything I'm talking about can be used in intraday. Let me explain why. And indexes. A lot of the indexes, the semiconductors, the Dow, the S&P, the opening is almost always the same as the prior close. You probably never noticed that, but look at the SOX, the drug index. And, but anyway, because the Forex is a 24-hour market, what's going to happen is that here's the close. The next although it's not an official opening and closing time, almost all the vendors use 5 o'clock Eastern time as the opening and closing. This is 4:59, 59, and 59 seconds, or 5 o'clock, and this is like the very next trade. So pretty much all the time, the opening on the Forex is going to be the same as the prior close, within a pip or two. So with that in mind, you're not going to be able, the market's not going to be able to gap down as we could with equities, and then come back. So this is a piercing pattern in the Forex market. This is also a piercing pattern in intraday, because when you get into short time frames, 5-minute, 10-minute, 15-minute, the candle line on, say, a 15-minute chart, at the end of the 15-minute period, the candle line is formed. When does the next candle line start on the 15-minute chart? The very next trade. And unless it's overnight, in other words, unless the market's closed and then opens the next session, but during the day, almost all the time on an intraday chart, the opening on an intraday candle line is going to be the same as the prior close. Make sense? Anybody want me to go through that again? Okay. So this would also be a piercing pattern in Forex, in intraday, and also in the indexes. Okay, the more the white candle, now although the opening and closing are going to be the same, it doesn't mean we can't use the piercing pattern in the Forex or intraday. The more the white candle gets into the black candle, the more likely a reversal. In fact, if you mentally draw a blended candle, what would this look like? And you could actually, if you want to take a second or two to actually draw it. A hammer, right? It would be a hammer. And what color real body? Black. Now, if the white candle was less deeply into the black candle, what would happen to the black candle, the black real body on the blended candle? It would be a larger black real body. Okay, and this is what I talked about before. It's the opposite of the dark cloud cover, and the last bullet point is what I talked to about before. The related patterns are the in-neck, the atakubi, I don't speak Japanese very well, the in-neck, and the thrusting, shashakomi. You don't have to worry about them. Okay? Just take them out of your mental garbage up there and don't worry about it. Okay, so here we have a piercing pattern, which should be support. And this is interesting. See, this is the Dow, and I bet a lot of you didn't realize this, or maybe you did, but you see how the openings and closings are all about the same? Here's the opening, the same as the prior close. The close here, or the opening here. The close here and the opening here, a lot of the indexes, the opening and closings, are going to be the same. So the lower the piercing pattern becomes a potential support area. Okay, here we have the doji. We're not concerned about the doji, as we discussed before, because the market just started the rally. Why are those not piercing patterns? It's interesting because in the Japanese literature, I mentioned before with the dark cloud cover, some of the literature said all it has to do is close below the close of the white candle. Some of the literature said it has to close below the middle of the white candle, and I went with the latter. With the piercing pattern, it's no definitional differences. It has to close above the middle of the black real body to show that the bulls have taken over control. Although the first candle wasn't the long black candle, what pattern is this? What is it? The one we looked at before. A bullish counterattack. And this is a nice example, although it wasn't a long black real body. Do we see a real example, a real shift in psychology? In that one session? What do we have here? What's that pattern? A bearish what? Bearish engulfing pattern. How many would sell there? Obviously you know the market rallied, but why would you not sell? The gap, the window. And again, this is an example of how education is really going to separate you from the competition. Let those traders who know enough about the candles to be dangerous say there's a bearish engulfing pattern and sell just before the market rallies, $15, $20. It's a perfect time not to sell. Okay, here we have it intraday, and it's okay to have the opening and closing the same. This to me is still a piercing pattern. And that's not a piercing pattern. The one with the red arrow, the white body didn't get halfway into the black candle. Did you see that? And fine to use volume. Any of these candle patterns, we're not focusing on Western technicals, but maybe, you'd look at volume. You'd want to see light volume on this black candle and higher volume on the white candle. Okay, and this is interesting. Early shifting clues of supply and demand. So the first green arrow on your left, it's almost, the closes aren't the same. I wouldn't really be viewing that as a bullish counterattack because the white candle really didn't gap down that much lower. But it's really interesting. Look what happened right around that same support area. On the second green arrow, not quite a piercing pattern, right, because it didn't get in the middle of the black candle. The third green arrow was a piercing pattern, so it was interesting how the white candle kept on creeping higher and higher into the black candle. Nonetheless, even if this third candle line was not a piercing pattern, I would certainly take notice of this situation because time after time, who's in charge here? Bears. What would we, if the market was weak, what should happen in the next session? Okay, did it? No. Who's in charge here? Bears. Probably getting a little optimistic. What happened the next session? The bulls came back. Not aggressively, but were the Bears able to maintain control? No. So do you think the Bears are getting a little bit more nervous now? Sure. Maybe the bulls are getting a little bit more confident. And although this is a piercing pattern, even if it wasn't a piercing pattern, I would still be certainly out of shorts here. Because time after time after time, the Bears tried to pummel the markets, and they just couldn't do it. So, but this piercing, because it was a piercing pattern, that could be a time to go long. The fact that the white candle got below the middle of the black real body, above the middle of the black real body. Any questions on the piercing pattern before we move on? Now, as we move more deeply into the white intruding into the black, we have one of our favorite patterns, right? The engulfing pattern. So the market has to be in a downtrend, white wrapping around the black. Okay, so let's go quickly to the strict criteria. In other words, we're looking at strict to increase the likelihood of the signal working out, either as a reversal signal or as a support or resistance area. The first candle should really be small or doji. because we want to see the prior momentum, in other words, the downtrend running out of steam. And then we have a white candle, a tall white candle, not surprisingly, visually showing us the bulls are getting a foothold on the market. Another aspect is that it's better, again from my own experience looking at thousands and thousands of charts, that the white candle also wrap around the shadows. It's taking out the whole range. See, the basic definition that we've talked about before in my other resources with the engulfing pattern is the white candle wrapping around the black candle, which is certainly true, real body wrapping around the real body. But now, to be a little stricter, it's the white candle actually wrapping around the high-low range of the prior session. Okay, the pattern psychology, I think, is pretty self-evident. The first candle, we want it small to show us the prior trend is losing steam, reflecting a diminishing of the bearish force, and the tall white candle showing, as I said here, leaves no doubt that the bulls are now in the driver's seat. Of course, it leaves no doubt if the market closed under the low of the bullish engulfing pattern, we're wrong, right? All right, so as of that time, the bulls are in charge, but once again, the candles are only giving us probabilities to evaluate. Doesn't mean the market's always going to rally. So we use the low of the bullish engulfing pattern, whatever the lowest low of the two candlestick lines are, whichever has the lower low. So in this case, this is not a strict bullish engulfing pattern. So whatever has the lowest low, so in this case, the first candle line, that lower shadow would be our support area based on the close. And realize, getting back to the great question on price confirmation, if you have a bullish confirmation, if you have a bullish engulfing pattern, any of these patterns, you can use price confirmation. You have a bullish engulfing pattern, you want to be a little bit more confident, you can wait for the next session for higher opening or higher intraday move. It's true with all the candlestick signals, all right? So, but if the market moves under the low of the bullish engulfing pattern on a close, it's a time you're wrong if you're long, or if you're a momentum trader, you'd be selling. Okay, and that's why it says consider shorting under the low of the bullish engulfing pattern. So let's look at this. We're looking at FX. And once again, whatever I talk about pretty much in FX is true with intraday and indexes. And we're going to talk about indexes in an upcoming session when we talk about sectors. Okay, so a bullish engulfing pattern is fine for the opening and closing to be the same or within a couple of pips. And the reason I give it a couple of pips is because data vendors may have slightly different prices. There's no official market in Forex. So that's why I give it a couple of pips difference. The pattern has less significance if the candles are about the same size. We want to see the first candle small and the second one larger. Okay, the first candle, as I've mentioned before, can be a doji. And we're going to look at the Hadomi pattern in a little bit. It's the opposite of the candle combination is the opposite. With an engulfing pattern, the first candle is small and the second candle is large. With the Hadomi pattern, the first candle is large and the second candle is small. And for those who don't remember, that pattern, we'll go through it a little later. And don't have to worry much about this, but I just wanted to bring it out. If a bullish engulfing pattern appears during a rally, the Japanese call it a last engulfing pattern, and it may be a buying climax. Okay, confirmation would be a close under the close of the white candle. Okay, this is not an important pattern, but just think about not buying. So what this means is that if we have this particular pattern during a rally, remember, bullish engulfing patterns come after what? Downtrend. If we have this particular pattern during a rally, okay, first of all, it's not a bullish engulfing pattern because the bullish engulfing pattern has to come after a downtrend. But if that's very high volume white candle, it could be a buying climax. Remember we were talking about buying climax before? It's like the last longs, we're waiting to get in, finally get in, and there's nobody left to buy. Right? So a very high volume, bullish engulfing pattern after an extended rally could be a buying climax, and the confirmation would be on a close under the close of the white candle. Don't worry about, I would never sell on that, but the point is I would not be buying on that. Okay, a bullish engulfing pattern has to come after a downtrend. It's not a bullish engulfing pattern if it comes after an uptrend. And emphasize the importance of trend. Okay, let's read this. I recently purchased a technical analysis package from a well-known, quote, technical analysis guru. During the charting presentation, he made several references to candlestick patterns. Be a little nervous. Somebody else is making reference to it. Be careful about, other candlestick information. Everything as I mentioned before, has been corroborated by 2 or 3 sources. I see candlestick patterns. I have no idea where these traders get it from. The candlestick signals I'm teaching here are pedigrees. They've been refined by generations of use. Chopstick patterns. I don't know. You know what chopsticks are good for? When you go to a restaurant, you wave them over your head and say, "Bring me a fork." Right? Okay. During a strong uptrend, he called a large white wheel body after a small black wheel body a bullish engulfing pattern. Okay, if I remember right, a bullish engulfing pattern doesn't count during an uptrend. That's certainly right. If I hadn't bought and studied your package, I never would have known that and would have assumed he was right. So essentially, this, and we'll go through this here, this may not be the chart he's referring to, but just to show you the concept. The black wrapping around the white is a bearish engulfing pattern, and the trend is correct. This is a white wrapping around the black. Isn't that a bullish engulfing pattern? No. Yeah. I mean, the combination is right. It's the white wrapping around the black, but remember the trend. So somebody who just understood what the pattern looked like would say this is a bullish engulfing pattern without taking into account trend and just would have bought at exactly the wrong time. And with the recognition software, that would not be a bullish engulfing pattern. So here we have in the Forex market, okay, the 2 blue arrows. Okay, the first one is not a piercing pattern because the white candle didn't get more than halfway into the black one. The second blue arrow on your left is a piercing pattern, right? And then we have some bullish engulfing patterns over here. The question is it tweezers as well? Yes, great point. Yes, tweezers as well because the lows are the same. Good call on that. Okay, so in here, that's the little green triangle. That's a bullish engulfing pattern, by the way. Okay, that's how the recognition software picks it up. W is a falling window. And so let's go through price. Let's use price confirmation on the bullish engulfing pattern over here. And one of the great things about the candlestick recognition is sometimes small gaps are very hard to see. If you ask the software to look for gaps, you're going to see red W's for falling windows and green W's for rising windows. So it'll be really easy to see. Even if it's a 2-cent gap, it'll pick it up. So here we have a bullish engulfing pattern. And if you were waiting for price confirmation, it didn't happen, right? And that would have kept you out of a potentially bad trade. Over here, we have another a bullish engulfing pattern. We did get price confirmation with this the next session. Everybody see that? The market moved above it. It closed above the bullish engulfing pattern. But the risk is still to the low of the pattern. So even if you're waiting for price confirmation, say you buy it either above the close here or above the high, your risk is still the low of the bullish engulfing pattern. And you'd have to ask yourself, if you're buying it here, and you have to look at the risk-reward, if you buy it here, my resistance would be a zone here at this falling window. See how this falling window became resistance? Right? Okay. So it did hold as support. Now, so you'd have to ask yourself, is the risk-reward, and probably is, you'd have to work out the numbers, is the risk-reward, and most traders will look for a 2-to-1 reward risk, maybe even 3-to-1 on this. So this price confirmation probably would have been okay. And by the way, why do I have a resistance area at this window here and not at this one? It was broken. The market closed above it, exactly. And see how this window over here became resistance on the close also? So here we have price confirmation, which would have worked out okay from a risk-reward perspective. Okay. Here, it all depends on when you're waiting for confirmation. So a little bullish engulfing pattern. Although the real bodies on both the doji and the black, whatever you want to call it, and the white candle are not that big, what I liked about this engulfing pattern is it wrapped around a couple of small real bodies. Also, what was happening to the lows? Kind of stabilizing, right? We're going from lower lows to the same lows. This was probably a hammer also. Okay. And probably the law of the hammer, looks like it may have held as support. But getting to this idea of price confirmation, if you waited for a close to confirm the bullish engulfing pattern, the close, in other words, of the next session, look at this. You wouldn't have been able to do the trade. However, and there's nothing wrong with this, just a move intraday above the bullish engulfing pattern. See? As soon as it gets above here, you think about buying it. That's an okay risk reward. So it's going to be in your ballpark. If you want price confirmation, which I think is a great idea, if you want to kind of get the best of both worlds, in other words, hopefully not buying at such a high price like you would on the close here, but buying with confirmation, so you wait for a move above the bullish engulfing pattern intraday, say here, your risk is still down here, and my target would be the pivot, the recent high up there. Okay, why would you not buy on this pattern? That's a nice bullish engulfing pattern. It actually, the white candle wrapped around the entire session of the black real body and the shadows. Okay, think about, we didn't discuss this yet, we'll discuss this in future sessions, but for those who have been to my prior seminars, the third leg of the triad, candles, Western technicals, trade management. Risk reward. Think about this risk reward. Okay, if you buy it here, my resistance, I think we would all agree with this, right? Would be the highs here. Okay. So we would not be buying on that pattern. We have a rising window here, right? That's why it's part of the reason it held. So a couple of things to do here. If the low of the bullish engulfing pattern, okay, so the low of the bullish engulfing pattern here, if you bought it here, because the bullish engulfing pattern was holding as support, if you bought it here, what happened in the next session? You're wrong. So the market closed under the bullish engulfing pattern, also closed under the rising window. Everybody see that? Close the rising window support level. So close into the rising window. Now you could think about, if you're not long and you didn't have to be stopped out, if you're flat, you could think about a momentum trade. Or you might actually, Bristol Myers, you may be negative on Bristol Myers and you're waiting for time to sell Bristol Myers. Rather than buying on a bullish engulfing pattern or on a test of the bullish engulfing pattern, you're looking to sell. You sell, in this case, it wouldn't only be under the low. The bullish engulfing pattern would have to close under the window, right? But this could be your selling opportunity. So some of you may not be wanting to sell or buy a market. You're waiting to sell it. Use the close under the bullish engulfing pattern as your momentum short sale. Okay, the Harumi pattern is this is the only one I kept as Japanese to my regret because I still have trouble pronouncing the word. It's a combination between, you have to do an R sound and an L sound. It's like a harumi, and I can't quite get it. So sometimes I call it a harumi, and but it's one of the hardest words that my translator told me. You have to do a cross between harumi and halami. So anyway, I kept this as Japanese because it means pregnant. Small real body and a big real body. The Japanese will call this the mother candle, and this is the baby or fetus. And the reason I didn't keep it as call it a pregnant pattern is because when I was doing the research, I worked at a trading firm, and the last thing I need to do is, be around a lot of traders talking about pregnant patterns, and with a trader's sense of humor, I'd never hear the end of it. So this is the only one I left as Japanese, and all the others I had, translated into English. So it's a double candlestick line. We'll go through the basic criteria again because this is one of the basic patterns. Two sessions. Market should be in a downtrend. But the trend is really not that critical. This is not a major turning signal, by the way. We'll go through that in a minute or two. The second candle is much smaller. And for my recognition software, I'll give you one of the parameters that I did decide on. The second candle has to be 25% or less than the first real body. The second candle can be the same or the opposite color of the first candle, which is different than the engulfing pattern, right? The engulfing pattern, the candles have to be opposite. And the second candle, it's a small real body, and it has to be within the first candle's real body. I don't use this as support or resistance. And I don't use it for momentum trading. In other words, if we have a bullish Harami, I don't use the low of the Harami as a support level. Once again, it's based on my looking at, I can't tell you how many charts. So, and I don't use it for momentum trading, because if you don't use it as support or resistance, that means if you break it, it doesn't mean that much. And the psychology is the black real body. And the first real body has to be long, unusually long. Okay, and what unusually long is proprietary. We defined it in the trading, in the recognition software. Essentially what we've done is we looked at X number of candles. We went back a certain number of candles and said that this candle has to be 50% longer than X number of candles ago, than the last X number of candles. So the first candle has to be unusually long because the bearers are in control, and then the second candle is showing us that there's a lack of downside follow-through, okay? And as shown here, the bears are seeing that the drive is becoming impeded. Okay, so, Forex, intraday. Opening and closing can be the same. Okay, if the second candle is a doji, it's called the Harami cross. Okay, most of you are probably familiar with that aspect. And this is important. The more the second real body gets deeply into the first candle, the black real body, the better the signal. And we'll go through that a little bit later. Now, the next one is a downside for Forex traders. Because the Forex market, and for those not familiar with Forex, we mean currency. Because the Forex market, white candle can't get deeply into the black candle, it's best to wait for bullish confirmation by a higher opening or a close above the white real body. Let me go through that for you Forex traders, or for those who are thinking of trading Forex. Okay, let me go through this here in Forex. And for those who are in equities who are thinking, Forex is really cool because the advantage of the Forex is you're looking at maybe 4 markets. Okay, it's not like thousands of markets. You could trade in the middle of the night. There's a lot of cool things with the Forex market. Very liquid, tremendous leverage. Okay, so here, the opening and closing. Here we have the opening. Here we have the closing. This is the only way you're going to have a Harami in a Forex, because if the opening was here and the opening was here and the closing was down here, would that any longer be that pattern? No. So the Forex, it's going to be like this. So with that, because the real body is hovering near the lows, we would want to wait for some price confirmation. Okay, and in general, the less the second candle gets into the black candle, the more confirmation is needed. And it makes sense. Let's say we have this as compared to that. Which is more likely reversal? Number 1 or number 2? Number 1 is more likely reversal because the market gapped higher and was able to sustain those higher prices until the end of the session. Everybody agree with that? Make sense? Okay. And this is the opposite of the bearish Harami. Okay, so here it's I don't like the word bull Harami because it implies like it's really bullish. Maybe we should call it less bearish Harami or something. The Japanese would say the bears are losing their breath. Okay, so here, again, it's the idea of a real separation of trend, really long black real body, and the next candle is a spinning top, a small real body that's within the prior real body. And it's showing us a shift in psychology of the market, not quite bullish, but we would all agree less bearish, right? And this, I would not view this as a buy signal, but maybe as a time to scale back on shorts. If you're shorts, to cover some shorts. Okay. Next session was interesting. Next 2 sessions, what do we have? A bullish engulfing pattern. Okay, that to me would be a buy signal. Okay. And we talked before about a potential buying climax when we talked about the last engulfing pattern. I just touched briefly on it because it's not a really important signal. A buying climax is when we have a tremendous spurt of buying, and there's no, when I talk about high volume, it's subjective, because high volume, as I mentioned my prior resources, high volume, 10 million shares in one stock may be high volume and another stock may not be. So we look at relative volume. So a selling climax is the opposite. Here we have a bullish Howder Me, and, well, actually there's two of them here. And I don't know if this quite was within the real body, but let's say it was. This, to me, this is a bull Harami. We want bullish. Why would we want bullish confirmation here? It's there, right? The second candle is still near the lows of the first candle, right? Nothing really positive about it. The trend turns less negative because that Harami pattern, that small real body in the prior black candle. But to me, it's not really bullish. I would want to see at least positive confirmation. Here, look at the spike, and what I did was, instead of just having volume as vertical lines, I made it as a line chart. Look at the spike in volume on the black candle. Okay, that could be a potential selling climax. What that means is the opposite of a buying climax. Those longs who are holding and holding and holding and holding and waiting and waiting and praying to get out at a higher level just finally capitulate. So it's like those last the longs who are holding on finally give up, and you know that's a bottom, right? And so we have a potential selling climax, and here we have a Harami pattern. Now, because of the spike in volume, you may say, okay, you're not going to wait for bullish confirmation. Normally I would say wait for bullish confirmation because the close is near the lows, but I would still be more comfortable having bullish confirmation. Okay? But so you have a lot of pluses going on here. You have a potential selling climax, you have the Harami, and what happened in the next session after this one? Yeah, we got bullish confirmation, right? A higher close. And notice how nicely it held as support. And actually, what happened on these two sessions? Small real bodies, but nonetheless, what pattern is this? Bullish engulfing pattern, yeah. So a lot of stuff going on here. Okay, here we have a bull Harami pattern. Market broke under it, shift into, if you're long, once again, if you're long because of the Harami confirming a little piercing pattern over there, as soon as it gets under it on a close, this would have, on a close, you would have been out of the longs. You know, although we're talking about support on the close, there's going to be a time intercession. If you're long, you're not going to be able to wait until the close, right? Because the market may be well beyond your threshold of pain, intercession. This is a nice momentum trade. The market closed under there. And although I normally don't, as I mentioned before, I don't use the Harami as a momentum trade, I would see this a piercing pattern. That I would use as a momentum trade. If the market closes under the piercing pattern, we would use that as a momentum trade. So here, and we had the change of polarity, old support becoming a resistance area. Now we're moving along with the white candle getting into the black candle, bull sash. Both candles are long, and we have, I should say, we'll look at the strict criteria. We have a black real body. The next day the market gaps higher on the opening, and then it continues moving higher. Okay, there's a bull sash pattern. And it's a black candle. The trend is not that important. Okay, it opens within the prior black real body. Doesn't have to open above the middle of the black real body. But the point is it holds above it during the session to close over the prior opening. So it's closing over this level here. Okay. Strict criteria. Both candles are long real bodies. Long black, bears are in charge. The next day, the market gaps higher on the opening, above the prior close, and importantly, it holds that level and moves higher from there. So we could see that there's a shift in psychology, as mentioned here, the surprise gap higher on the second day after a strong selling session may initially be of minor concern. Okay, the market gapped higher in the opening, big deal. But by the close of the white candle, the bear sense danger and also give the bulls cause for some optimism. So it's a bull sash pattern. Can't have this in Forex because we have gaps. You can have this on intraday from the close of one session to the opening of the next session. because you can have, gaps intraday from one session to the other, but within the day, it's rare to have this on intraday. The higher the market gaps, and again, this makes, if you think about it, it makes sense. The higher the market gaps, higher on the opening, and if it stays up there, the better the signal. Okay, now we start moving into risk-reward. When we start getting patterns like this. Because what's happening is, a lot of times when you get this pattern, a lot of the move may have been completed already. You may be near a resistance area. And this is the downside to initially what look like positive candlestick signals, but by the time you get them, it's a poor risk-reward. And this is what some other analysts don't talk about when they talk about candles. And we're going to look at some examples. If the opening of the white candle is the same as the prior opening, it's a bull separating line. We're going to look at that in a minute. So in other words, if the opening here is the same as the opening here, and this white candle keeps on going higher, it's a bull separating line. We're going to look at that as we progress next. So here, it's a black candle. The way you remember this is a black candle. The market gaps higher the next day, and a white candle, and just keeps on going higher from the opening. It's a bull sash pattern. And this might have been an okay trade. Yes, because the low of the sash, the bull sash, should be a support area. So if you're buying it here, your risk is all the way down here. See? So this is your risk. The reward would be up here. The potential target would be over here. So it might be an okay risk-reward. Here we have a bull sash pattern, and the trend is not that important with this particular pattern. And we have two of these. And the first one on your left worked out really well, right? The market rallied after. The second one didn't. It doesn't matter if the first one worked out well. If you did the trade, it's a poor trade. Because when you got that bull sash pattern, why do you think I drew those red horizontal lines? It's a resistance area, right? We have no idea if the market's going to break support or resistance, right? So it's easy in hindsight, but those are both poor trade candidates. Okay, now we're going to be looking at the continuation, the bull separating line. White candle getting even more above the black candle. And we think that's really, yes?
Going back to that bull sash pattern, are all of these patterns ones that you favor over others? Or are you just educating us as to different patterns?
As a rule, the more the white candle gets into the black candle, the more likely reverse, the better the signal. The problem is it's a poor risk-reward trade. So in other words, I think about this bull separating line. The market opens here, closes here. The market gaps higher in the opening, same opening, and closes the white candle. Is that a change in psychology? It sure is. But look at how late you get the signal. So this, we'd say is a really good signal as far as having, it should be a really good support area, no doubt about that. It's a good longer-term signal, but if you actually trade on the signal, the odds are it's going to be a bad risk-reward, and I'm going to show you an example of this in a minute. So a bull separating line, just very quickly, the trend is not that important. The market, have a black candle. The market opens at about the same openings. So here we have an opening here and an opening here, and then the lines are separating. You have a black candle and a white candle. They're going in completely opposite ways. And the strict criteria that both candles are relatively long, which is rare, but the white candle is important. It should close at or near the highs of the session. And you can read the psychology on your own. It's just obvious, right? Going from extreme bearish to extreme bullish. You can use the lowest lows as support and use as a support, and you can consider selling on the low under the bull separating line. So let's look at this here. Okay, and as I mentioned here, an easy way to remember this is that the openings are about the same, or at the same. Okay, you're not going to have this in Forex because the market has to gap higher in the opening. And the third bullet point is the important thing, and something I've alluded to before. Think about when you get this signal. How much of the move has already been completed? So it usually means a poor risk reward. We'll look at the bear separating line in a couple of minutes. And if the open of the white candle, instead of being at the, if the open of the white candle, instead of being at the same or a little even higher than the open of the black candle, if it's within here, it's a bull sash pattern. So here we have a bullish separating line. Okay. Now, here is a bull separating line. Okay. Although the openings aren't the same, it doesn't. The minimum requirement is the opening should be the same, or even if the opening of the white candle is above the opening of the black candle. So this is a classic bullish separating line. It looks good on the outside, right? The market rallied after. Okay, so if I showed you this pattern here, you'd say it worked great, but think about this in the real world. This is a really bad trade. Right. Okay, you get the signal on the close of the white candle. Where are you near? A resistance area at the falling window. Right? So, first of all, you're near a resistance area. So even ignoring that, if you're buying on this bull sash pattern, best case scenario, forget about this falling window here, maybe these major highs here, the Hadarmi here. I don't know if this is quite a bearish engulfing pattern, but this is a resistance area. So best case scenario, if you buy it here, assuming it's going to close above the falling window, your price target is there. Okay. Let's think about the risk of this trade, folks. Okay. You buy on the close here, you're looking at least at the windows, right? You're looking at the windows. So your risk is the same as your reward. So somebody would show you a chart like this and say the bull sash pattern works great. In the real world, this is not a trade you should be taking at all. So, same thing here. A bull sash pattern, although the market continued to move higher, bull separating line, A bull separating line, when I was talking about before, it should be a bull separating line. A bull separating line, although the candle pattern, and if I called it a sash pattern here, I meant a bull separating line, obviously. If a bull separating line here, although it worked out nicely, we had a little rally, look at where this emerged. Right near a resistance area, exactly. So, and that's the challenge with a lot of these patterns. So here's a separating line, a bull separating line. The open is here, the market opens, gaps much higher, right at resistance. If you buy it there, you're buying right at the wrong time. So it's nice on the outside, but there's really not much to do with it. As far as a trading vehicle is concerned, except like we saw before with one of the other markets where we had the bull separating line and you had a nice price target many, many dollars away. So let's go over what we learned with the bull double candlestick lines. Once again, we did my 360-degree candlestick analysis. We saw the bullish counterattack pattern. What we did was we went with the candle progression. We went white candle, moving more deeply into the black real body. We went from bullish counterattack to a piercing pattern, to a bullish engulfing pattern, the bull separating lines, the bull Hadarmi, and confirmation. Remember, if the Hadarmi has the real body near the lows of that long black candle, we want some bullish confirmation and so forth. And how some of the candle patterns, the bull separating lines, maybe the bull sash patterns, as good as they look externally, they may not be a great trading opportunity because of the risk reward. And we're really going to focus on trade management when we look at other sections of the seminar.